Welcome to Talk Tickers, your shortcut to the critical signals streaming from corporate earnings conference calls.
Today we are doing a deep dive into Applied Optoelectronics, or AOI. We're looking at their Q3 2025 results from the call on November 6th. And this one was really less about the past quarter and more about the future they're trying to build.
Exactly. And this is such a critical company. It's sitting right at the intersection of two massive growth stories.
Two monster cycles.
You have the explosive demand for AI data center optics on one hand, and then this huge once-in-a-generation upgrade cycle in cable infrastructure on the other.
Right.
So our mission here is to really break down the story of AOI, where these huge sky-high expectations just ran headfirst into some near-term execution problems, and that led to a lot of volatility.
And that volatility was the story of the day. So let's start with a quick snapshot, because the numbers themselves were all over the place. They really set the stage for the panic that came out.
Okay, let's unpack it. Revenue came in at $118.6 million.
Which, on the surface, an 82% increase year over year. That's massive. It shows the demand is definitely there.
It's definitely there. But it still ended up being a slight miss. The consensus was, about $119.8 million?
Yeah, so about a $1.2 million miss. And, for a company that's priced for perfect execution, that small number caused a huge problem.
Right.
But what's so fascinating is that on the profitability side of things, they actually beat expectations.
They did. Non-GAAP EPS was a loss of 9 cents per share, which was better than the street's consensus. They were expecting a loss of 10 or even 11 cents.
And crucially, you can see the profitability engine just starting to turn over. Adjusted EBITDA actually turned slightly positive.
$2 million positive. And you have to remember, this is a huge swing from a $7.7 million loss just a year ago.
Exactly. And non-GAAP gross margin also got a nice bump up to 31%.
So we have this really clear picture. Margin beat, EPS beat, but a small revenue miss, and, as we'll get to, a soft Q4 guide.
And the market's initial reaction was just violently negative. It tells you that investors prioritize that top-line miss and the forward view over everything else.
So what does it tell you?
It tells you this company is being judged on one thing and one thing only: its ability to capture AI volume. And any little sign of a delay or a hiccup is just met with, extreme skepticism.
That sets us up perfectly for the segment dynamics, because the whole quarter was really this massive divergence between their two core businesses. It's like a tale of the steady star and the AI hiccup.
Absolutely. The CATV segment, the cable TV business, was the undisputed record-breaking star of the show.
It really was the safety net for the whole operation. Cable TV hit an all-time company record, $70.6 million in revenue.
Think about that. That's 60% of their total sales.
And it grew an astronomical 237% year over year.
Sure.
Just incredible numbers.
And this is all being driven by that next-gen cable upgrade cycle. Specifically, the continued ramp-up of their 1.8 gigahertz amplifier products. Management said demand was broad-based.
Yeah, they mentioned big shipments to Charter and 6 other major MSO customers.
Right, the multiple system operators, the big cable guys. And they're all adopting AOI's new QuantumLink software and amplifier solutions.
So for our listeners, why is this specific adoption so important? Why is the 1.8 gigahertz amplifier and that QuantumLink software such a critical piece for AOI stability?
Well, it's critical because it shifts their revenue to higher margin products that have a really long tail. This 1.8 gigahertz standard, it's complex. And the software layer, QuantumLink, gives these cable companies actual intelligence, diagnostics, remote management.
So it creates a sticky relationship.
Exactly. It's a sticky long-term relationship. It leads to predictable, high-quality recurring revenue.
And management is clearly banking on that. They reiterated their confidence. They expect to hit over $300 million in CATV revenue for 2026.
And that's not just from amplifiers. They're rolling out new nodes, new software modules to keep that growth going.
So if we connect the dots here, this CATV strength isn't just a side story.
No, not at all. It's functionally bankrolling the entire massive AI capacity transition. The cash flow from cable is paying for the futuristic gamble on the data center side.
Which makes the performance of the data center segment that much more scrutinized.
A whole different ballgame over there.
That segment delivered $43.9 million. So, a modest 7% growth year over year. But it actually fell slightly, about 2% from the previous quarter. That is not the explosive AI growth the market was hoping for.
And this is exactly where that execution hiccup happened.
Yeah.
Management pointed to specific shipping and receiving delays right at the very end of the quarter.
Yeah, they called out $6.6 million in 400G transceivers. That's not small change, destined for a huge hyperscale customer.
Right. And the story is the customer just couldn't process the delivery in time to book the revenue in Q3. The trucks were there, but the paperwork wasn't done.
So management says, look, it's just a timing issue. We'll recognize it in Q4.
Huh.
But I have to challenge that a little bit. When you're already guiding below consensus for Q4 anyway, is citing a logistics issue with a massive customer at the last minute, is that really just a timing issue? Or does it signal, a deeper risk in dealing with these giants?
That is exactly the right question to ask. It just highlights the lumpiness, the risk you have when you rely on just a few massive customers. A $6.6 million operational slip-up, a truck getting unloaded too slowly, was enough to sink their overall revenue number. It shows you that in this sector, you have zero margin for error.
Precisely. Well, regardless of the delay, management was very quick to pivot the conversation back to their AI bet and their big capacity ramp.
Oh, yeah. They were aggressive in framing themselves as a leading U.S. supplier of these high-speed optical modules for AI data centers.
And this is where the plot really thickens. Their entire roadmap is focused on the future, 800G and 1.6T transceivers, the things you need to feed those hungry AI GPUs.
And they confirmed they are in the final stages of 800G qualifications with several key customers.
Which is huge. That confidence translated directly into their operational plan. They're still expecting to produce meaningful shipments of 800G products in this fourth quarter of 2025.
And that, right there, is the single most important hinge point for the stock. Getting those qualifications done and turning them into actual revenue.
But qualification means nothing without scale. And they are building scale fast. They reiterated plans to exit 2025 with the capacity to build 100,000 800G units per month.
And the domestic angle is fascinating here.
It is. They're pushing hard into North America. About 35% of this new capacity is going into expanded U.S. facilities in Texas. Why the aggressive push into U.S. capacity right now?
I think it's threefold. Geopolitical stability, supply chain security, and maybe most critically, customer demand. The CFO said it directly.
He did.
Demand for U.S.-based production is incredibly strong. He said customers have a strong preference for production in North America. For these hyperscalers, building sensitive, bleeding-edge AI stuff, securing supply chains away from Asia, it's becoming a competitive necessity.
So that huge capital spending is focused on 800G now. What about the next leap?
The 1.6T transceiver ramp is slated for 2026. They expect volume shipments around mid-year, so think June or July. It's an aggressive timeline. They're burning cash now to capture market share later.
And they are certainly burning cash. The company is in heavy investment mode. They've logged almost $125 million in capital investments just this year. That's way ahead of their initial projections.
It is, and that's a massive CapEx bill to justify when you're still booking non-GAAP losses.
So how are they paying for it?
They've been raising money through, well, yes, dilution. They did a big $342.6 million common stock offering. And importantly, they initiated a $180 million at the market, or ATM, equity agreement.
Okay, can you explain the difference there? Why does an ATM signal sort of opportunistic fundraising?
Sure. So the big stock offering is a one-time event. You raise a huge chunk of cash fast. An ATM, on the other hand, is a more flexible, lower-cost way to raise money over time. It lets the company sell shares directly into the market whenever the stock price is favorable.
Without all the big underwriting fees.
Right. It signals that management believes their long-term equity value is strong, and they're willing to fund this expansion continuously. And it worked. It helped boost their cash position to over $150 million.
That cash gives them a long runway. But their ability to deliver really relies on a key technological advantage they have.
Vertical integration.
Exactly.
What gives them this huge strategic edge is their in-house laser manufacturing. They don't have to wait in line or rely on third parties for the most complex, most important component.
It prevents shortages, especially for those high-performance EMLs.
Right, the electro-absorption modulated lasers.
Yeah.
But they also talked about supporting silicon photonics or SiPo solutions, and that's maybe even more important for the long term.
Okay, for our listeners, why do they see SiPo as having more long-term scalability compared to traditional EMLs?
It all comes down to manufacturing scale and cost, especially when you get to speeds like 1.6T and beyond. EMLs are discrete, expensive little components. Silicon photonics, though, lets you integrate optical and electrical circuits right onto a standard silicon wafer using the same processes as semiconductors.
So you get the benefits of massive scale.
Massive scale manufacturing, higher yields, smaller footprint, and a much lower long-term cost. And you absolutely need that when you're talking about producing hundreds of thousands of these things every month for AI clusters. The fact that they can serve both camps, EML and SiPo, is a huge advantage.
Let's pivot back to guidance because this was the real source of that initial investor panic. They missed Q3 slightly, but the Q4 guide, it really spooked the market.
It did. The Q4 revenue guidance was set really wide, from $125 million to $140 million. And the midpoint of that fell noticeably short of the street's consensus, which was closer to $144.6 million.
And they're guiding for another non-GAAP EPS loss, somewhere between 13 cents and 4 cents per share.
So you have this clear trade-off. The market is laser-focused on the near-term soft guide, the dilution, the continued losses, all the present pain.
Meanwhile, management is trying to tell a story about structural growth, temporary hiccups, and capitalizing on the AI cycle, the future promise.
And to anchor that long-term vision, you have to remember two key strategic points. First, that 10-year, $4 billion supply and warrant deal with Amazon. The exercise price on that warrant is $23.70.
And that warrant, it's often called a psychological floor. But it's more fundamental than that, isn't it?
It is. It's an alignment mechanism. Amazon has a massive financial incentive to see AOI's stock price go way up. It validates their supply commitment and guarantees them access to capacity. It's a huge institutional signal of long-term confidence.
And the second anchor is management's own ambitious target, $1.9 billion in total revenue by 2027.
Right, which is heavily weighted towards that data center segment.
And the clash between that long-term story and the near-term reality is just reflected so sharply in the stock's performance. AOI is down, about 34% over the last month?
Yeah, and to put that in perspective, the SOXX index, the benchmark for semiconductors, was only down about 4.5% in that same period.
That difference is staggering. It suggests the market thinks AOI's specific execution risk is nearly 10 times higher than the average semi company.
It's a massive confidence gap, and it's one that can only be closed with meaningful 800G shipments starting, right now.
Which makes this a really high-stakes, asymmetric moment for the stock. The analysts are all over the map. Price targets from $15 on the low end all the way up to $35.
Which brings us to our high-stakes segment.
This is not financial advice.
And let's be very clear, this segment is purely for conceptual discussion. We're just examining a potential opportunity presented by this conflict between the long-term vision and the market's immediate skepticism. The stock is fundamentally volatile.
Okay, so the core thesis here is that the market is over-discounting the eventual success of the 800G ramp and that path to $1.9 billion, all because of the immediate CapEx spend and the dilution.
Right. We need a way to bet on that future while trying to minimize the pain of the present volatility.
And that's where the Amazon warrant comes back in.
That $23.70 price is the key psychological pivot point. A long-term asymmetric bet needs to capture the upside if, and it's a big if, AOI successfully hits that 100,000 unit per month 800G capacity goal. That would trigger a major repricing of the stock.
So conceptually, the play is a long-dated, leveraged bet on success.
That's funded by the short-term risk premium. Precisely. We'd consider a long-dated, out-of-the-money call strategy. Think 9 to 12 months out, with strike prices positioned just above that $23.70 warrant price. It's a bet that the 800G ramp and margin expansion become undeniable in the first half of 2026.
And to pay for the cost of those long calls, you sell short-term, out-of-the-money puts.
Correct. You use the market's fear about near-term execution risk to generate income now, which you then use to fund your bet on a long-term AI success story. It's a bet on timing. It's a bet that their fortified balance sheet is strong enough to weather the next 2 quarters, allowing the AI narrative to take over once those 800G shipments start showing up as real revenue.
So let's try to quickly summarize this very complex deep dive. We saw record strength from the CATV business, the engine that tripled year over year, and improving gross margins that are basically paying for this massive capacity bet they're making.
But the modest Q4 guidance miss, combined with that little Q3 revenue hiccup, it put immense pressure on the stock. The entire investment thesis now hinges on one thing: 800G qualification and volume ramping up. Management says meaningful shipments start this quarter. We'll see.
So the final provocative thought for you to consider is this. AOI is placing a monumental bet. They are funding it with dilution and cable upgrades, all to secure a leading position in the AI data center market. Will this massive investment ultimately lead to profitable scaling and validate that ambitious $1.9 billion vision for 2027?
Or will fierce competition and execution delays, like that $6.6 million logistics miss, continue to define their near-term trajectory? That question determines if AOI is the next breakout infrastructure leader or just a high capex value trap.
A challenging story for sure. Thank you for joining us for this deep dive. We'll see you next time on Talk Tickers.